Hello and welcome to lesson number 7 of this course, which is unfortunately the last video of this course. And if you've made it this far, that means you've gained a great deal of knowledge and are probably too excited to actually begin trading. But before you do that, this is what you need to do first. Something called backtesting. And what backtesting is when you look at previous data samples so you can practice your setup and your trading skills. Because obviously, just by watching one video and writing down notes, that doesn't mean you're gonna become the most successful trader. That's just unrealistic. For you to actually fully grasp the concepts behind these ideologies, you would need to spend lots of time backtesting and understanding the reason behind it. And you also need to train your eye to see these concepts. So now I'm gonna show you how to backtest. The first thing you'll do is look to the left of the chart and go back a period of time. So wherever the current price is, whatever day it is, you'd go back a bit to the left to previous days and start backtesting there. You do a top-down analysis starting with the daily to find where price is drawing to, just like how I teach you to identify your bias. You'd mark out the key areas of interest, such as any inefficiencies or liquidity. Then you'd scout your setup and write down the reasons why the market moved in that specific way. Once you have a large enough folder of backtests, review them and look for similar characteristics which happens consistently, so you can put it into your own words why the market is moving that way. And then you need to backtest until you feel that the setup is second nature to you and it's clear of the movement behind the market. Once you feel confident with the strategy, you would open a demo account to actually gain more experience and confidence with this setup. So let me show you an example of a backtest. Remove these drawings here. Now we'll go into the daily. Alright, so let's look at this fractal here, this piece of price on the daily. First thing we see is that price traded to this swing low, taking out these key levels. So that gives us an idea that price already took the sell stops and should now be trading higher to where? To the key levels in our chart. As you can see here we have a gap. Let me change the color. Here we have buy side liquidity. Same in this swing high, buy side liquidity. So you would mark out your liquidity points. Then you'll see here that there's a bit of a consolidation on the daily, but then you'll see this displacement higher. So once we've seen this displacement, we can expect price to retrace lower into this breaker block before trading higher. So let's go into the smaller time frames and into this breaker block level to see what price is doing. So when we zoom in, you can see price had the wick below these equal lows before this initial displacement. So our underlying bias would be bullish because price took out the sell side liquidity here. Then we've seen this displacement confirming our bullishness in price. So once you've seen price make a swing high, you would draw the swing from the low to the high. And let me just clear this so it's easier to read. So you'd see price trade back down to below the 50% and the bodies of the candle exactly on this breaker block level. So now all of our criteria has been met to go long. We had a run on the liquidity here before a displacement higher, which confirms our underlying bias. Then price was to retrace to the discount of our range and is in confluence with this gap being filled and the breaker here being at that level. So you would open a long position here keeping stop loss at the bottom of this range and aiming for this point first before this inefficiency here. So we want to see price take out this high before price trades higher, going to fill this inefficiency, and that's exactly what we see. So this right here would be an example of how you backtest. So you would draw it out. You would type out exactly what's happening. Run on sell side liquidity. Sell side liquidity with the underlying bias being bullish. So that's one of our criteria. Next, we want to see a displacement, and we see this displacement with this swing here. Displacement above this key high, giving us our confirmation that market is bullish. So once we've seen that displacement, we'd mark out the range. Once we see displacement, we would mark out the range and wait for a retracement into the discount of the range. Pretty simple, pretty straightforward. Then once price is at the discount of the range, like here, we would look for confluence. So once price, waiting for a retracement, at the discount, while looking for confluence to the left. So price came to the discount, we'd look to confluence on the left, which is this here. It's literally to the left. We would see a gap and a breaker block. So that's enough for us to go long, keeping our stop loss below this range. And our target for the long, the first target would be this high here. So first target is the range's high. Then we wait to see if price will reverse or continue trading higher to our next key level. And in this case, price traded up to our next key level, and our next key level was a gap in the marketplace, because this gap hasn't been filled yet. So we know that price has to fill this gap, and it's in line with our bias. So that's what this is. Up down to the 4 hour. So we would go along here, expect price to take out this swing high first before going higher to fill this gap. And once we've seen this gap get filled, we could close our position and just wait to see what price does next. So let's see what price did next. So let me clear this. The next thing that price did was price came, took out this short-term sell side liquidity with this swing low here, but our bias is still bearish. Still bullish. So that's what we want to see. We want to see price make a run on the sell side liquidity because we're bearish before a displacement higher. And here we get our displacement with this move taking out these equal highs, giving us our bullish shift in market structure. So now there's two things of the criteria which have been met. The liquidity being taken, followed by a displacement, which gives us our bullish shift in market structure. So once we've seen that those two, we would drag the range from the swing low to the swing high, and we'd look for price to retrace back into this key area here. We'd see price come, fill these gaps here, react to the order block, before going long. So once we've seen price is at a discount and it's filling the gap and it's in our order block level, we would go short, keeping stop loss at the bottom of the range while our target is above the swing high of the range. And as you can see, price did exactly that. It went up, taking out this buy side liquidity before price retraces. So you would just put that into words. First, liquidity being taken by this, and be displacement higher, giving us our bullish shift in market structure. Put it like that, giving us our bullish shift in market structure. Then we would wait for a retracement into the discount, looking for confluence to go long. Confluence to go long. We get our confluence in the form of FFGs, which are fair value gaps, and a bullish order block. Because of this confluence, we would go long, expecting the first target to be above the range's high. And that's exactly what price did. Liquidity got taken. That's the manipulation in the marketplace. So there's money in the market. Price was to trade higher with a displacement, which is giving us our bullish shift in market structure and confirming that price is bullish, followed by a retracement lower to fill these gaps and for price to wick down to the order block before going long. So when we are buying, we would want to see price at a discount because price is cheaper. So price at the discount, filling the gaps, order block, we'd go long here, keeping stop loss below the range before price trades higher, taking out the range's high. So this would be how you would you should backtest, and you should have enough screenshots of this before you open a demo account and practice there, because you really need to practice, because everything might make sense to you right now, but when you actually go into the charts on your own, it might not make sense. So that's why it's key to backtest, so you're fully grasping the information that was being taught to you in this course. So once you have enough backtesting, you'd open a demo account and trade with fake money before you feel comfortable enough to put an amount into a real account. And don't let anyone tell you that it's time to actually put money into a real account. Only when you feel confident and comfortable in your trading skills and with this trading setup, then and only then you would actually put money into the market, into a real account, and begin trading. But I should not tell you when to do it. Your friend shouldn't tell you when to do it. Only you tell yourself when to actually begin trading real funds. And I hate to say this, but this is now the end of this course. I really hope you guys enjoyed it. And if you have any questions at all, or any queries, or just want to give us a review, please send it to this email here, contact@yratrading.com. And if you're gonna forget the email, don't worry, it's somewhere on the website. I think at the footer, which is all the way at the bottom of the website. And yeah, that's it, guys. Good luck and good trading.